Only one trade-a-day trend indicator has been designed based on the combination and crossover of two kinds of MAs, fast and slow. Like other crossover trend signal indicators, it doesn't make your trading chart clumsy with tons of average lines. It works in the background and signals the trend when it gets confirmation about a possible trend to be started. Only one trade-a-day trend indicator works best for newbie traders who struggle to sort out the MA crossover signals while trading. It works best to trade major forex currency pairs and fits well with M15 and H1 charts for intraday trading purposes. As the name suggests, the only one trade-a-day forex indicator for MetaTrader 4 provides one sniper-accurate trading signal every day. The trading signal appears on the main MT4 chart window in the form of a buy or sell arrow. The indicator is very reliable, lightweight, and will not slow down your trading platform. Buy and sell signal: a blue-colored arrow is a buy signal. A red-colored arrow is a sell signal. The indicator can also be used as an additional signals indicator that works together with an existing trading strategy or system of your preference. The indicator works equally well on all currency pairs, majors, minors and exotic, and shows promising results if used correctly. Trend indicator is very simple and at the same time profitable indicator, not repainting. According to this indicator signals, we will open only one position per day for one currency pair. But the open position will not immediately appear an arrow of trend indicator, and when to do some action. More on that later. Characteristics of trend indicator platform: MetaTrader 4 currency pairs, any trading time, 1 trade a day time frame, M30 recommended broker, RoboForex, XM, Forex 4U rules of trade by trend indicator: short trade red arrow down, draw lines on the maximum and minimum values of the prices, red horizontal line, in the time interval between 0:00 to 03:30, GMT +3, vertical yellow dotted lines. Set the pending order sell stop on 5 pips below the red line, the minimum price, green horizontal line. Stop loss set at 1 pip above the upper red line, maximum price. The strategy applied on a trading day. Like every day, traders start by analyzing all the products on which they are used to trading. Imagine, for example, 12 products. After analysis, it appears that only 3 of the 12 products are inspiring. On the first one, it is felt that if the support breaks, the bearish movement should continue. Well, on the second one, the price is in a range. Prediction are that there might be a rally, but there is not yet an indication of direction. On the third, the tendency is bullish. As long as the price does not plunge under a certain level, there are indications that the rising movement could easily be prolonged. On these 3 products, traders know that they are only going to trade once today. They therefore focus on these 3 products and wait for the right moment to enter into position. They don't even look at the other 9 products after analysis. They know exactly which products, at which prices, in which directions they are going to trade these products today. There is no question of going against the direction afterwards, of cutting the position to reopen it a little later, or of looking at other products in case an opportunity arises elsewhere. It is possible that an opportune moment, on some of the selected products, doesn't present itself. It doesn't matter. The time to enter presents itself. The trader calculates the amount of his position based on his risk management, and therefore his stop loss. He will then choose whether to use a take profit or move his stop loss accordingly. Not to mention his trading strategy's performance objectives. One of the trades is finished. If there is added value, so much the better. The chart is closed. If there is capital loss, too bad. The chart is closed. There were 3 trades to make today. 1, 2, or 3 were completed. On those which won, the trader took as much as he could take. On those where lost, his scenario did not come to fruition as hoped and he took his loss. And finally, on those that didn't come to fruition, he didn't win or lose, but didn't make any mistakes. Very important. What are the advantages of this trading strategy? This trading method makes it possible to avoid multiplication of trades and thus errors. Always wanting to be in position on the market, for example. Having a number of products to process allows traders to stay better focused. They avoid having to